The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with us for this Daniel Code webinar. I hope you can all hear me all right. Yes, Terry says he can hear me okay in Canada, so I guess the rest of you can hear me, subject to the vagaries of the dreaded internet. But great to have you with us. Lots of our old friends here today. Nice to see you all with us, and crikey, we've got a good roll up today. I'm glad you're all here because this is going to knock your socks off today. Brian up at We War there, and my friend Chase, who chastises me for smoking. Daniel, Daryl Cool. Hello, Daryl, over in Mossman. Hello, he's a good mate of mine. Daryl Narain, of course, one of our real stalwarts, one of the very best traders we've got. Don Maydell up in Canada. Hi, Don. I hope you got my email about your short-term trading. Okay, Harold Fuchs. Harold's over in Reading. He's a gold man, big time gold trader. Lovely Janet up in Canada is coming to Los Angeles for the tutorial. Yes, and Jim Brown, new member. Jim, I hope you got my email. I need to talk to you if you haven't got it. Johnny Barnes coming to Los Angeles. Kevin Coyne. God, there's a name from the past. Kevin, good to have you with us. Maryland with us. Love to see Maryland here. Have to say hello to all of the girls. We don't have many ladies with us, but it's nice to have them. Mike Fowler's here. Gosh. Everyone is lots of people here. My old mate Peter Andrews, Peter Keller. Yeah, lots of guys here. All good. And Rob H. from New Zealand. Hello, Rob. How are you, mate? Stephen Casterly. Stephen's up in Alberta, up in the coal country. He works in the oil patch up there. Tom, Janet, Tom, nice to have you with us down in Florida. Vicky, lots more. I can't go on forever, but hey, folks, I want to give you a different take on trading today. I want to show you a little bit about how I trade, and I do all the things we do on the website, but there's another dimension way beyond that. I'm going to give you some ideas about it today to get the grey matter working and get you thinking. This, if you're interested in all of this stuff, I'd be more than happy to teach you. Good to have you with us. Okay, let's move on and see what we've got. Here's our nice pictures for the upcoming summer tutorial in Los Angeles, 24 to 27 May. We only have one tutorial a year in the United States, that part of the world. So if you really like to learn how to trade well and safely, I'll look forward to seeing you there. Go to the website. There's the syllabus is there. The details are there. It'll be great to see you there. It's only going to be a small tutorial, and that's better. It means I can spend more time with you. Okay, let's move on with the things I want to talk to you about today. First of all, market turns are neither random or accidental. You've seen this chart before, but it's really worth showing it to you again. This is the fourth SEALs forecast of the recent, last year, really low in gold. Those who follow the Daniel Code will know that we started forecasting that in November with the low in the Huey, which then transferred into what's looking now like a pretty decent low in gold. What we need to do more and more is, and I think a lot of you are not able to do this, is be aware of trend. And if you filter your Daniel Code trades with some unique trend analysis, you will find that you really get very, very much better results. This is a daily chart of oil. This is something you can play around with yourselves. It's just something to get you start thinking. This is a fairly very simple, unsophisticated method of seeing trend. Don't worry too much about the colors in the background. They're from our GMAG program, which I teach at tutorials. But what we have here is we have a blue line and a red line. And they're just very simple. They're moving averages. They're in fact displaced moving averages. So moving averages themselves don't actually tell you a lot because they don't have any forecasting properties. They're simply mimicking what the chart has done. But these moving averages here are displaced. In other words, you can see them forward. You know what the forecast numbers are going to be. And you can stick these on your chart. This is simply a displaced moving average of the high. That's the blue line. It's a 6-period moving average of the high shifted forward 3. And if you don't know how to do that, have a talk to Trade Navigator. It's very simple. In fact, those of you who haven't done the courses at Trade Navigator learning how to manipulate these studies, I really recommend that you do those courses. And the red one is the invert. It's a simple moving average of the lows, 6-period shifted 3. And you'll get some ideas from this if you look and get the grey matter thinking. You can see that in this period here, can you all see my cursor okay? Terry, can you see my cursor on this chart? Or do I need to get the spotlight feature out? Anyone going to tell me? Nobody's saying anything. Just type it into the questions box if you would, guys. Can I use the spotlight? Yes. You don't see it. Okay. Good. Just thanks for that advice from everyone. Let's get the spotlight so we can see where we are. Okay. And round about here, you'll see, I'll put this to show the bar we're talking about, and then move it down. I might even be able to give you a date for this so you can look it up on your charts. Just let me get that chart up. This is oil. This is in fact the this is in fact the June contract. This is not the continuous contract. It doesn't matter. It all works exactly the same. So let me just show you what this date is back here, which I'll get on another chart for you. So this particular bar we're looking at here is the nice little outside bar on the bar before it. The outside bar is October the 15th, 2015, in case you want to put it on your chart. So we have a close below the red displaced moving average, which tells us that the trend is down on this particular study. Now, keep these things compartmentalized in your head. Don't let everything run into everything else. All of these systems and little methods that I show you have their own good qualities and occasionally some not so good. So don't run it into everything. Terry's saying you can't see the chart. Oh, that's the chart. It's in the PowerPoint, Terry. That's a page in the PowerPoint. So that's the date of that, and you can see in here. I can actually blow up the chart if anyone wants me to. Just whack it into questions, and I'll do this actually on the live chart. But there's a close on that date below the red line, which tells you the trend is down. And it's not apparent any other way. And then you get one bar up, which is your signal. 1 to 3 bar counter trends are your signal to enter. So you can sell the next bar, which is going to be, we're now up to 10 October 19th, 2015. You can sell that next bar and you get a decent little rundown out of it. When you get up here, we're up to a date of October the 30th, 2015. You have a close above the blue line. Then you get an inside bar, which is a signal to buy it. It's one of the counter trend signals. So you can buy that. You get a nice buy signal. It's great. And you'll see this all the way down here on this little tiny bar here, which looks very obscure. That's the date of that is November the 10th. You have an open at 48.24 and a close at 48.27 on that bar. So that's actually an up bar, because we can construe an up bar either from a higher high, higher low, or from the open-close relationship. So what you've actually got right in there is 1 bar up and you can sell it. That's a valid entry signal. You can sell that, and down you go. You get about 3 or 4 days out of it. But if you just simply want to trade for the first profitable close, you'll find that this method of filtering your trades is absolutely enormous. Down here, we're now down to, let me make sure I've got the right one here as this moves along. We're now down to December the 2nd. There have been plenty of trades in between, but this is the next one that's interesting. You've got your close here miles below your red downtrend line. This trend recognition works on the close. Then you get 1 up bar, and that's the signal to sell it. 1 to 3 bar counter trend. To get back with the trend, we're looking for those 1 to 3 bar counter trends to sell them. So we're with the trend, and here we get another big trade here. Same thing here, outside bar, inside bar. If you've got short on the outside bar, that's not valid, but that gives you a higher high. Then an inside bar, you can sell that, another winning trade. Down to here, we're now down to this date is December the 14th. 1 bar up, sell it, another winning trade. So you get all of that. And this just goes on and on and on, all the way through here. And it's a terrific way to filter your trades. Okay, I want to talk to you now about waterfalls. They're going to be pretty much one of the big topics of today. I had a phone call last night from Louis, our Dutch friend in Switzerland. Those of you who went to the LA tutorial last year or the Waiheke tutorial in New Zealand this year met Louis. He's a dasher. He's a very, very nice man, a very smart man too. And Louis was a very successful, had a very successful business in the fashion business, and he's a bit of a fashionista himself. You know, he'll turn up for breakfast in a yellow shirt and light blue shorts and matching light blue jogging shoes, whereas, you know, the rest of us are either in navy blue or white or khaki. But Louis is really miles ahead of us, and he sold his business, and he's been playing with trading for many years but wanted to get really serious about it. So he's been to our last 2 tutorials, and he rang me yesterday to tell me about these waterfall trades. I was talking to Daryl about them last week. Anyone who's done a tutorial lately is all over these. And I thought I'd just show you this big picture idea that instead of looking just to exit the first profitable close, these waterfall setups are the trades that you can hold sometimes for very, very long periods. And the interesting thing about them is that all of these, we call them waterfall trades because when I first identified them, they were all going down. Since then, we found some techniques for trading them on the way up as well. It's not quite the same, but it's the setup similar. And all of these waterfall trades start off exactly the same way. They have the same characteristics. And once you can see these waterfall trades, you can hold them for very long periods of time. This is crude oil since about September last year. And you can see that just the waterfall trades on this chart have made about $40,000 from only 6 trades. For those of you who like to hold your trades longer, this is a way to really make some big money. And it's pretty relaxing because once you've entered and put your stop on, you can be really neglectful like me. As long as your stop is good till cancelled, you only have to look at the charts once a day. And there may be occasions when you need to move your stop, but you can see some of these trades run for very, very long periods. They're quite extraordinary. This is this first signal you see there, the buy signal in oil, ran from August the 27th through to October the 12th. And that signal, October the 12th, started there and it finished up closing out that trade on January the 22nd. So you can see some of these trades run for very, very long periods. And these are daily bars. And I'm also going to show you them on weekly bars, but they're quite extraordinary. And you can see that you may not see yet, but you'll see some of the characteristics here. I want to get you thinking about this and see the opportunities for trading that are here. Let's move on to the next one. And one of the things when you look at this stuff critically, and incidentally, don't go to a lot of trouble trying to reverse engineer these. This is how this works. I teach at tutorials. You tutorial guys should be going nuts over the waterfalls we've had lately, and they're always there. And if you really want to know how to do this, come and see me in LA. But don't waste a lot of time trying to reverse engineer this, because these are not my actual charts. These are charts I've made up to demonstrate these trades to you. But they're not perfectly accurate, because I know that a lot of people enjoy coming to these webinars and seeing if they can reverse engineer what I'm doing, and the answer is no, you can't. So we'll come back to you with all your questions. Jim, that's great. But have a look at this. You see the green dots, it says gaps. And if you look at where the vast majority of these waterfall moves are starting, you'll see that there's a gap there. And where there's not a gap, then there is something that equates to a gap, which you can't see on these particular charts. But gaps are actually magnets. Gaps, markets hate leaving gaps. They always try to fill the gap. And what you'll see here is that these are gaps that the market doesn't fill or is unable to fill. Really good example here. This is the start of a waterfall trade in oil, which started on October the 12th, and then you can see the rally which runs up here, and it's tried really hard to close the gap, and it hasn't, because that gap starts at 52.36, and the high of that rally 51.63. It tried to close the gap, which is what markets do almost all the time. When it can't close the gap, that's a real feature that you see in these waterfall trades, and it's quite extraordinary the amount of money these trades make. And if you can learn how to hold your trades like this, you'll have as much money as you could possibly want. It's extraordinary trading. Louis was also telling me he was very excited and wanted to tell me and wanted me to tell you, those of you who now know about waterfalls from tutorials, he's trading these waterfalls on ETFs and on stocks. And I don't do stocks, but Louis does. And he was saying on stocks, it's absolutely fantastic. It works exactly the same. So any of you people who are interested in stocks, think about utilizing this technique. It's not my advice, but Louis is a very, very sensible guy and a very serious trader. So he was tripping over his tongue yesterday, or the day before rather, with excitement about how these waterfall trades were running for him in stocks as well as ETFs. So quite extraordinary. Here's another chart, just show you the same thing. All markets have these waterfalls. Sometimes they're not as dramatic. As you can see in coffee, it's had a huge period from November 15 all the way through to March 16, where it's really been in a sideways market with a false break up and a false break down. But the waterfall has run all the way through there. And then when you do get the breakouts, the waterfall certainly catches those. So you can see that quite simply. This next chart here is more waterfalls, but to this one, it's the same chart you saw just now, but I've added the gaps. So for those of you with an inquisitive mind, you should be thinking about the gaps you can see and the structural gaps that you can't see. And this is to do with the difference between chart high, chart lows, and true high, true lows, which I've talked about in previous webinars, and we teach you at tutorials. Very important to know that, because you can see that almost all of these waterfalls are actually triggered by a gap. There's actually one more in here that I haven't put on the chart. You can see where that spotlight is, there's another gap in there. So all of these fast waterfall moves are associated with a gap. Here's the gap in here. You can't see it on this chart, but if I move this highlighter away, you'll be able to see the gap down there. It's a little green dot in there, so I should have put a gap dot on there to highlight that for you, but I can tell you the date if you'd like to look at it on your own charts. That's going to be up in the reverse, and we're on the 057 chart, which is the continuous contract, and that kick out of there is 0212, folks. So pretty extraordinary stuff, isn't it? That these unclosed gaps are what triggers these moves, and they're ones that you can't see are actually there, but you need a slightly different construction of the charts to see them. So that's coffee for you, and look at the money it's made. I mean, this is absolutely extraordinary. So no wonder Louis is terribly excited about this, and I can tell you I'm just as excited as well. I've been trading. I haven't taught this until fairly recently at tutorials, but I've been trading this stuff for years and years, and it is really knockout stuff, and it's also a very simple way to trade because it's not stressful, and once you get your stop on, you have a number of alternatives of moving your stop, or if you're like me, you can just leave your stop where it is until you get the reversal signal. You're happy to take the risk on entry, to take your entry trade, and if you are happy to do that, by and large, you should be happy to maintain that risk as the market moves away. But you can use any one of a number of techniques to move your stops, and I'm going to give you some ideas about that towards the end of this webinar. This next chart you're looking at now is sugar. And I wanted to show you this so you don't get the idea that all of these trades are winners. There are some that are losers. You can see the ones in red are losers, and there were 3 losers in the period from September 15th to date. Losing trades are an inevitable part of trading. Don't ever try and optimize your trading to get rid of all losers. Some of them are highly technical, like this one here. I'll give you the date of that as well so you can see it. In reality, there was no reason to be stopped out of that trade at all. That's the 057 chart. That bar that actually stopped out the trade on the way I'm showing it to you was February the 19th, but in fact what that is, that's a false break, and it was actually a Daniel code blue line buy signal, and false breaks lead to fast moves is something worth remembering. So I've shown that as a loser because it was stopped out exactly to the tick, in fact. This is the 067 chart I'm showing you. This is another form of back adjusted chart. With the 057 charts in Trade Navigator, they're just each of the front months laid next to each other. But the result of that is they have very big gaps, sometimes on rollover. How the 067 charts are constructed is that the front month is accurate, but all of the previous months are adjusted by either the premium or the discount on rollover. And what that does is it gets rid of the big gaps on rollover. Those big gaps on rollover, let me get the 057 chart up here, can in some cases give you a false impression. So when you're doing these waterfalls, those of you who know how to do them, you should be using the front month. Or what I've done here is I've shown you an 067 chart which gets rid of the premium or discount on rollover. One of the drawbacks of the 067 chart, don't forget, because it does that, it also creates prices that are not real. And if you look at the 067 all-time high in gold, it's considerably different to the 057 or the front month that gave us the all-time high in gold. It's just a mathematical construct that you adjust for the premium or discount on rollover. And sometimes, if you think about that long term, if you've got rid of all the premiums and all the discounts, there is some validity to them. And occasionally we do use an 067 chart for forecasting purposes. And that's the one I've shown you here. But I wanted you to be aware they're not all winners, and you shouldn't try to optimize your programs to get rid of losers, because losing trades are an essential cost of doing business in trading. Now, to maximize this big picture view, I want to take you to a weekly chart. There are really good reasons why you should keep weekly charts. There are also really good reasons why you should keep 6-day and 12-day charts in particular, those of you who are interested in forecasting. But this chart you're looking at now is copper, and this is the weekly chart, and we've done exactly the same thing here. I'm showing you here the waterfall trades on copper, and this goes back to about July 2014. So this is getting on to 21, 22 months of trading, and there's only been 5 trades in that time. So these are the trades you can hold. Remember, these are weekly bars. So each of these bars is a trading week, and you can do exactly the same thing on the 6-day bars, where each bar becomes composed of 6 trading days. They're in fact, if anything, slightly better, but I want you to see this for those of you who are really laid back. But you have to remember, this is a beautiful way to trade in trending markets, but these waterfall signals are so extraordinary that they only occur when there's sufficient volatility to trigger them off. And every one of these waterfall entries, it may not be obvious to you, but they have exactly the same properties that create the trade. So they really are quite extraordinary. But you can't trade from a weekly chart. You need the weekly chart for your analysis. It gives you another view of markets. It gives you an in-depth view of markets that you don't have from the daily charts. And I often notice when I'm doing the members charts for you on the website that particularly with the futures contracts, when you're trading in the front month and you're doing your analysis in the front month, you don't see, you don't see the bigger retracements because they're simply not on that chart. In other words, the highs, these big highs here and here were made. This was made in a September 2014 contract. This high here is made in a June 2015 contract. When we're doing our analysis here, we're not looking at those charts because we have to do the form of analysis we do at the website. You have to do off the daily charts, and we're now in the May 2016 chart. And sometimes these front month charts, you simply don't see those bigger swings, and the retracements on them are still vitally important. So it's a great argument to say that, hello, Tony DD, nice to have you with us, mate. This is being recorded, Tony, so you can catch up on what you've missed, but we're great to have you with us. This is the argument for why you should keep weekly charts as well. Now, I know for a lot of you, there are time constraints, but for markets that you're trading all the time, you should certainly have weekly charts with the Daniel code retracements on them. If nothing else, you can't do anything else except use those retracement tools. But I used to do weekly charts, and I haven't done them for some years now. Because they weren't getting used. People weren't looking at them. We know from the counters inside the website which charts people are looking at, and I was churning out 30 or 40 weekly charts updated twice a week, and hardly anyone was looking at them. So I know your attention's all on the short-term stuff, which is great. That's the basis of all this trading, and you have to be able to take your entries and manage your risk from daily bars. but I'm trying here today to show you that there's a much bigger picture out there, and if you can get your head around this big picture and learn to trade these longer term swings, they're very, very profitable, and they're very easy to trade once you know how. Here's gold. I know you're all, a lot of gold bugs are here, and you can see here that this is the 057 COMEX gold chart, which you've seen. We've had this running now for since about September last year, I think, maybe earlier. We showed it to you, started showing it to you about July 15. We started getting interested in this chart, and this is a waterfall trade down, and this is a waterfall trade up. And it's pretty easy to identify from the weekly chart once you know the rules. But as well as that, I wanted to show you how you would take your entries. So you can't enter from a weekly chart simply because the bars are too big and your risk is too big. If you want to, you can use other techniques like trailing stops, dollar trailing stops. You can say, I want to have $1,000 stop, a $2,000 stop. That's all valid, but trying to enter from weekly charts, you're going to get burnt. So what you've got to do is, once you've identified, this is the bar here, and I'll just get the date of that for you. Let's have a look. Here we are. Just bear with me while I find that date. It's that one there. That's the January the 8th on the weekly chart. That's the bar that ended on January the 8th. So once you've got the confirmed signal from the weekly chart, you then go down to the daily chart. In other words, we've done our analysis. You'll see this will change in a moment. There you are. You'll see we've done our analysis from the weekly chart, but we're now looking, how do we enter it from the daily chart? And you'll notice a number of things. Once you go down the time frame, you start seeing lots of other things. Over here, we in fact had our first daily waterfall buy coming out of the low. Once we go to the daily chart, this bar here, this set up the weekly buy trade. And once we've done that, we then need an entry signal to get into the trade on the long side. And the easiest way to do that is to get a Daniel code trading signal, which we got on this bar right here. I'll give you these dates because I know this is not great to see how these things, the places that they all are. So let's go and have a look at the gold chart. And we'll be able to find the date of that entry. Bear with me while I find the 057 chart here, folks. Got charts and computers all over the place, which is jolly good fun until you want to find something in particular. But there it is. So there's the there, we're up to here with the outside bar there. So the date of that is January the 8th. That's the same bar. That's the last bar in the weekly chart that said to you, this is a valid up waterfall trade. But you had to enter. You can't just buy there. You got nowhere to put your stop. And logic tells you should be putting your stop. If you're going to buy at a daily high, your stop should be below the daily low. Now, I know you can use shorter term trading stops than that, and some of you are very keen to do that. Don Maydell, you sent me an email about, wanting to trade 120 and 240 minute bars. Mate, I used to do that, and I used to teach that at tutorials, and I promise you, it's stressful. You've got to be sitting there watching your charts all the time, and it's also prone to fatal mistakes, because the only true support and resistance in markets is Daniel code numbers and daily true highs and daily true lows. And if you're trading those shorter term bars, you are very likely to be trading what is at that time an inside bar. And that's a taboo, because if you're trading an inside bar, there's no real support or resistance, and the market makers can do anything they want with it. It really, you make the money. Just have a look at these charts I'm showing you, Don and others. You make the money by trading this way. Now, this is a daily chart, but we've taken our analysis from the weekly chart, and this is where we wait for. We then get a TO3 buy signal in gold, which is very nice to have. And the date of that, let me see, is there was one up there, was January the 15th. Okay, so you got in on January the 15th with a TO3 buy signal, and guess what? On the day of entry, you did not have a profitable close, so you had to hold the trade. The next day was an inside bar. You still didn't have a profitable close, so you had to hold the trade. The day after, another small bar, this time an outside bar, came nowhere near your stop. Your stop's underneath this low here. And then what happens the next day? Whoosh, you get a nice up bar and you get your profitable close. So normally what we would do, if we're just trading daily bars, we exit on that first profitable close, say thank you. But if you're trading waterfalls, you say, I know this is a waterfall trade and I'm going to hold this and get a whole lot more out of it. And in fact, if you were patient enough and you were trading from the weekly chart, you've got almost $15,000 per one contract out of this trade. That's trading from the weekly chart, which we looked at a moment ago. If you go down to the daily chart, you can see you get a daily sell, a waterfall sell here that fails, and you get another waterfall sell here, which gets you in a whole lot earlier. It makes a little bit of money because you get a waterfall buy right here. So that's the difference. I'll just see if I can take you back to the previous chart, because you'll see what I mean. That's the difference. This is the weekly chart. You have one trade using the weekly chart all the way up. If you go down to the daily chart, you get a buy there, a sell there. That negates the buy. You're wrong in the market. If you're taking off the TO3, you get the entry there. You get a daily signal here that fails. You get a daily signal here that is profitable. And then eventually you get onto a buy signal. So for those of you who want to hold these trades longer, let's think about this big picture that we're talking about. Don't be frightened to try and get this stuff working on the weekly and the 6-day charts, if you like. It really does give you a huge opportunity. You only need to get a few trades a year away, and you make a whole lot of money. Okay, so let's move on. And what we've done here is we've looked at the weekly analysis. We've identified a waterfall buy signal in gold, and we've then gone down. As soon as we got that signal, we've gone down to the daily chart to say, how shall we enter? We believe from that at the moment the trend is up, so we're looking for a buy signal, and 3 days later we get a TO3 buy signal from the Daniel code, and you sit holding that because you don't get a profitable close to get out of that trade for 3 days, and by the time that third day comes around, you should be pretty comfortable that you're in the right way in a waterfall buy pattern in this market. And you know where your stop loss is. It's the normal risk that we use for all of our daily entries, and you should be very comfortable with that. If you want to move your stops up as this market moves away, that's fine. You can certainly do that, but as I say, try and keep these things compartmentalized. If you're trading from a weekly chart, take your entry from the daily chart, then go back to your weekly chart. If you want to hold on to just trade waterfalls from the daily charts, that's fantastic too. It is really, really big money. Let's have a look why else you should be keeping weekly charts. This is sugar, and this is the weekly chart. And you can see up here, this is the high in June 2014. That doesn't even appear on the front month that we're in now. So on the weekly chart, just using your Daniel code retracement tool, 1657 was the 74% retracement, okay, on the weekly chart. And we would have seen that, we should have seen that, been aware that number was there, and it's not on the daily chart, okay? So that's why we have to keep weekly charts, and this is what they tell us. When we go from there down to the daily chart, this is the same chart. Here's that red line from the weekly chart, 1657. And let's run our way through here. This close here, get the spotlight again. This close here, let me get the chart up and I'll give you a date for this. This is pretty important stuff. Well, everything's important, isn't it? Money. Talking about money, this is the high before the high. It's the bar before. This is March the 22nd. And you can see that bar on the daily chart. This is the daily chart from the weekly analysis. We've now switched to the daily chart. That bar closed at 1658. One tick from the red line that was on the weekly chart. And for those of you, Jim, you're one of them who's been battling with the range of these target recognition in the DC trading manual for our new members. The ranges that you're given in there are maximum ranges. They're pretty big, but just train your eye by looking at the charts and you'll see how accurate these things are. Normally, it's no more than a handful of ticks, the target recognition. And this is a great example because you can have target recognition at the Daniel code numbers on either the bar high-low or on the close. Both are valid, okay? And this is the one that works on the close. And the close of this bar, this is sugar, March 22nd. The close of this bar is 1658. The red line from the weekly chart is 1657, to which you say, aha, this is Daniel code target recognition. If the other requirements are in place, I can expect a turn very shortly. You get, once you have that target recognition, it's valid for a few days. So you get the next bar up, that actually, if you look at the daily charts, the next bar up closed at 1671, and there was a DC blue line on the members chart. It's still there now if you want to go and check it, at $16.70. One tick away, Jim, the close from the blue line, and that set up the trade, and we got a TO3 sell signal the next day. So here you are, we're up to this sell signal here. You've got this big down bar in recognition of the Daniel code TO3 sell signal, which was March the 24th. Now, when that bar closed, almost all of you said, thank you, that's a great trade, we'll get out of that first profitable close. For those of you who know or would like to learn how to trade waterfalls, that bar there also confirmed that it was a daily waterfall sell signal, which means you're going to hold this trade. You can hold it if you like to have your stops a bit closer. You can hold it with a 2 or 3 bar trailing stop, or you can do what I do and just leave your stop there until you get the counter signal. And that little trade down there, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, has made $2,100 per one contract in sugar, which is one of the very smallest margin markets that you can trade. Daryl, you'll remember when we started bashing sugar with Fraxen, it was about, it was way less than $1,000. It might have only been $600, $700 margin. It's up now. The margin's much higher now. I think we've educated people. It's not a bad trading market. But have a look what happens here. Same thing. If we go back to these important lows here, this low happened on February the 19th, and that triggered a blue line buy signal in our Daniel code daily signals. So you bought it the next day, and the trade was elected on February the 22nd, where the little arrow is. but you didn't have a profitable close. So you had to wait to see if you're going to get a profitable close, and you did. On the next day, you got this massive, great big bar up here. February the 23rd, we were yodeling about this. We had blue line signals, TO3 signals, the works, and nobody knew except Daniel Code people, because what in fact had happened, the explanation for this, the belated explanation, was that the peak sugar body came out with their analysis of sugar production for the year, and they said, oh, crikey, there's going to be a huge shortfall, whereas their previous advice was there was going to be a huge surplus. So as soon as those numbers hit the machine, everybody bought. All the algorithms bought. All the people who follow news bought. But when that's explained, that's news after the fact. That's no damn good to any traders. We need to know before the fact. Okay, so you can see all the shorts got killed here. They had to buy to cover their shorts all the way up. But we had this signal 2 days before it happened. We had the blue line signal from February the 19th, gave us the signal, posted for action on Monday the 22nd, and the market barely moved. It just filled us on the buy side. And then closed well off its highs. Nothing to interest anyone, but we were long in this trade, and we got this huge trade up here. So this is was something of the region of, it might have been 6 or 7% in one day. It was a massive bar, biggest bar for years and years, and I talked about that at the time. But if you're just trading a TO3 signal, there was a blue line and a TO3 signal. Just trading a TO3 signal, you'd have got out on the close. If you were trading the blue line, you'd have used the 2-bar trailing stop down here. Look at this stochastic. This is the 533. We use a 2-bar trailing stop all the way up until the stochastic gets overbought, and we then, which is in this bar here, we then go to a 1-bar trailing stop, and we're actually stopped out below this little bar here, made a lot of money. If you knew about and were trading waterfalls, you made all of this money up to here. In fact, you made $3,000 in the waterfall going up, and $2,000 odd in the waterfall coming down. Just a fabulous way to trade. And I want you to think about this, open your minds to it, be aware of it, look carefully. What do you see down here? Right under this big bar, there's the gap. Okay, if you don't know about true highs and true lows, go through the Daniel Code webinars, because I've talked about it a number of times. If you come to a tutorial, I'll certainly explain it all to you. There is the gap. And that gap's a very common trigger on our waterfall entries. In fact, there's also a gap right up here at this high. But you can't see it on this particular type of chart. But there are a number of different types of charts, and we see it there. So that, I think, is pretty amazing. I hope you're as excited about all of this as I am, because, boy, we've made some huge money. Anyone who's been trading these waterfall trades. The key to all of this is identifying trend in ways that other people can't. And one of the best ways of doing that is with the fourth seal. Because for those of you who don't know, go to our website and you'll see that we have a fourth seal analysis on a number of markets. This is one of them. And within the fourth seal, even though at face value it appears to identify future turning points at Daniel Code time and price cycles, what it's also doing in between those turning points is it's giving you a very unique view of trend that the rest of the world doesn't see. And what we have here, this is a really good example of it. And this is the chart for copper. This is the front month of May. And we had this market going up to here. I'll get you the dates of this one as well, because it's a bit hard for you to see. The date of this high is March the 18th. And on the next day, for March the 19th, it was in fact March the 21st was a Monday, we had a Daniel Code daily sell signal. And it was elected, so we're short. It didn't look terribly good on that night, I can tell you. And then the next day, we had an inside bar. So we're now up to Tuesday, and we had a small bar with a run back up and an inside bar. We still haven't had our first profitable close. The next day, this thing goes whoosh, and you get this big outside bar, and this is March the 23rd. Now, daily sell signal, the normal thing is exit first profitable close. So for those of you who subscribe to the TO3 Plus signals, you got a nice trade there, made a good lot of money on that trade, exit first profitable close. However, if you knew about the bigger picture, you would have seen that that very same bar, this is the bar for March the 23rd, told you that this was a confirmed daily waterfall sell. In which case, you would have held this trade as long as you could. And if you were quite conservative and held it just with a 2-bar trailing stop, you'd still be in the trade now. It's made $5,000. If you tied your trailing stop to the stochastic, you'd have got stopped out. That was okay. This is still okay. You'd have gone to a 1-bar trailing stop on yesterday's bar. On Thursday's bar, Wednesday's bar, I should say, the high of which was 215.10. The outside bar high went to 215.35. You'd have been stopped out of the high of the outside bar on Wednesday. But to trade waterfalls, you don't need to tie them to a stochastic. As I said, you can either leave your stop where it was, like I do, or you can move it to swing highs that moves down. Or you can say I'm going to use a 2 or 3-bar trailing stop, but not tie it to the stochastic, because you can see when these moves end, they almost always end. You've seen half a dozen of these charts today. They almost always end with very high volatility, big size bars, and you can follow that through. And from the fourth seal, have a read of this. This is Frank DB, helps me with the preparation of these fourth seal charts and commentaries. We were looking for this high 2 weeks, a week before it happened. We were looking for this high. It had a 59 cycle high. It started the correction we were looking for. That we have had some support, short-lived, larger decline could resume later this week. And whoosh, down it goes. Follow the DC rules to get elected. And that is a $5,000 trade per 1 contract. If you keep bashing out these sort of results, you will be pretty close to the best trader in the world, folks. And that's what we're trying to get you to, being very, very good traders. Let's have a look what else we have for you here. We can move this on now. Stop loss strategies. Whichever way you're trading, we know how to move the stops on when you're trading daily bars. These are some of the things you can think about for your stop loss strategies. Particularly interesting, trailing stop 1 to 3 bars if you're trading waterfalls and longer term big picture patterns, as I call them. For your daily trades, you can use stops based on a percentage of the previous bars. You can use a dollar fixed stop or a dollar trailing stop as well, which means you work out what you're happy with in your dollar risk, and you place that as a fixed stop, or you can actually make that a trailing stop. So if you're a buyer, as the market goes up, your trailing stop goes up with it, so you're reducing your risk all the time. The question comes in when to use each stop. The methods I teach you at the website are the safest for trading daily bars. Same issue that Don and I discussed, that if you are going to use smaller than a daily stop, you're a bit in no man's land, because once you get your stop loss somewhere that's not true support and resistance, and the only true support and resistance is Daniel Code numbers and daily true highs and daily true lows. If you're not using those points, it's very easy to get whacked. People say, oh, they've run my stops, Very simple for market makers and other traders and machines, indeed, to run your stops if your stop is not at a Daniel Code number or at a market true high, true low. But there are all lots of ways you can do this, and think about all of those. Here's the reality of trailing stops. I showed you this chart last week, but I wasn't quite sure if I ever got to it because we ran out of time terribly quickly at our last webinar, which was 2 weeks ago. And this is just a mathematical model that we use for testing ideas. It's a huge database, and you can ask it all these questions. This is just a random market, but I think it was probably was gold. We spent a lot of time testing gold. And you can see these were the trailing stops. These are dollar trailing stop. And we started at $500 and went up by $500 to $3,000. Now remember, all of these signals are exactly the same for these tests. There are 6 different levels of test here. I'll just bring my spotlight back again so you can see what I'm talking about. We used exactly the same set, 111. They're just the neutral settings for this FRAC 2 program. Nothing fancy. We're not trying to optimize. They're just the most basic settings. But we said to the program, I want you to test what happens if you use a $500 trailing stop, $1,000, $1,500, $2,000, up to $3,000. And this is what happened. You made no money with the $500 trailing stop. You lost money with the $1,000 trailing stop. You started to make money at $1,500 and you get all the way up to $2,500 and $3,000. And look what's happened to your percentage. Now remember, this is exactly the same trade. The only thing there's a number of variables in any trade. There's the speed of the market, there's the angle of attack, there's where you enter, and then there are all these different options of stop losses that you can use. And on this particular setting, we've used 111 for our FRAC 2 settings. In other words, we've used a completely neutral entry. We've said when you get a signal, buy or sell it the next day, 1 tick above or below the true high, true low, which in fact defaults to 2, which is what we use for our signals. So nothing's changed except the size of the stop loss. And look what's happened. These are identical trades. And if you have a look what happens up here with a big stop loss, a $3,000 stop loss, you've made $9,000. This is for a fairly short period. It's from January the 1st, you can see over here, to March the 1st. This is only 2 months in gold. You could make $9,000. That's like 160, 170% on margin in 2 months, but you've got 95% win. You've had 19 trades in there, and you've got your big stop has given you 19 of those trades, but you've got 95% win rate, which is extraordinary. And if you look down the bottom, your win rate's just not there. And even though, it doesn't look too bad, some people would be happy with 67%, but you don't make any money. This stop loss thing is absolutely critical, and that's what stops most trades from making money, is the stop's too tight. And when you start trading, just trade exactly the way I teach you at the website. Please don't use bigger stops, but as you get more confident, be aware that the bigger stops give you a very superior trading result. And I talked about, I'm not sure if I even got to that last fortnight, but I really wanted to very correctly. Let me come back to you. We've got a few good questions today. And if you want to learn how to trade this way, come and see me in Los Angeles next month, 24th, 27th of May. It's at the Hilton Garden Inn at El Segundo. It's a nice little spot. We've had tutorials there before. Everyone's loved it. It's very relaxed, laid back. It's close to Manhattan Beach. Literally a 3 or 4, 5 minute at most cab ride away. Great fancy shops up there too for those of you who are bringing your wife or lady friend, or some of you, like Louis, may just like shopping. Louis was up there every couple of days. But email me, please, if you're interested in coming to the US tutorial in May. Jane Needham at thedanielcode.com. There is a link here for you to book your accommodation at the Hilton. We have a package deal there for Daniel Code people. And for the syllabus, go to the website. If you haven't already received a copy, or if you would like your own copy, email me and I'll send it to you. But it is on the website. So do please, those of you who are thinking of doing a tutorial, let me know, even if you're not firm at the moment, let me know your intention, because what we have done quite recently is for people who really can't do the travel. I've said for a limited number of people, I'll do the tutorial for you by video, and that takes 4 consecutive 2-hour sessions. And then that lets you tie in with the tutorial group to do the 4 follow-up webinars and one-on-one sessions whenever you want it. So if you really can't make it, I prefer you came to the tutorial because I love to meet you. I think I can teach you more clearly by being there personally with you. And of course, we're together pretty well all the time after the formal teaching. We go around the beautiful garden bar there, the patio, at the Hilton, and have some drinks and some small eats and talk about trading. So there's literally and probably another day of those after hours times when we're talking about trading, and it's all knowledge that's getting transferred to you. So do shoot me an email, please, if you're interested in coming, which would be great. And if you're unable to travel, shoot me an email and we can talk about doing it by video. Free trials, any of you who've not already done a free trial of the Daniel Code, we don't do any marketing, but we do invite you to try everything on the website. You need to just go to the website, www.thedanielcode.com, click on the free trial banner, register a username and your password. Email, if you would, the username to Terry at support@thedanielcode.com, and he will turn you on for everything: the 4th seal, the TO3 plus, the trade programs, everything, the members charts, and you can spend a month looking through all that and see what is suitable for you. So that would be great. And finally, I'm required to show you our compliance statement. And I do suggest that you are aware that there is a risk of losing money trading futures. And if you don't know how to trade futures, there is a huge risk of losing money. And I had a conversation with a very, very nice lady last week who's been trading on and off for years and years, lost all her money, done no good. Involved with a couple of trading groups where they get together and talk about the trading and the trades they're going to make, and none of it works. And I said, look, if you really are committed and you want to learn how to trade, come to a tutorial and I will teach you how. Well, she said, I'd like to make some money first before I come to the tutorial. And I said, you won't. You can't learn to trade from the internet despite what everyone thinks. And I have proven myself that you can't learn to trade from books either. You might pick up 1 or 2 things, but there's also an awful lot in them that is rubbish. And I said to her, the reality is that the industry says that 90% of people lose their money in their first bank in the first 3 months of trading. And I said, my observation is 99% of people will lose their bank in the first 30 days of trading. If you don't know how to trade, please do not risk real money trading. If you really want to learn how to be a very, very good trader, come to a tutorial and I will teach you how. So that's what I ask you. Don't waste any money trading until you are confident that you are a good and safe trader. Best way to do that, come to at least one Daniel Code tutorial. Most people come to more. Incidentally, to all our mates in Australia and New Zealand and some in America, I haven't got any repeat people from Waiheke coming to Los Angeles yet. And I know that from the webinars we did that most of you will benefit. Louis told me last night, he came to Los Angeles. He said going to Waiheke just cemented everything and put him onto a new level. So repetition is a valid way of learning. Okay, that's it for the moment, folks. Let me have a look at the questions. We have quite a few. Let me see if I can assist these folks. Just bear with me while I open this box up, and we'll see who's got what to say here. Jim, crude looks to be confirming an upward counter trend. Would you look at a closing price comparison to add to your position as it works down after confirming the trend, or would you be using the full height of the VAR to add to your position long after it ticks back up in line with the trend? Well, if you're looking to you've got an upward counter trend and you're trying to go short, Jim, you would sell any up bar in a 1 to 3 day counter trend if you're sure that the trend is down. Got that, Don. Tony D, I believe this was the US T-bond market on trailing stop chart. Oh, really? Was it? I don't know if I saw that, but thank you. The time period is 7 years plus, if I read the time period correctly. John Marlett has left. Don't know anything about that, John. We don't have any 7-year charts. That's it. Pretty quiet lot of questions today, guys. Anything else you'd like me to talk about, please send me an email, and I'll be happy to deal with it at the next webinar, which will be in 2 weeks' time. So, folks, I thank you for your attendance today. This will be up on the Daniel Code website in probably about 24 hours. Terry's pretty snappy these days. So this is the website here, and this is the banner to click if you'd like a free trial of anything. This banner down here, scroll down a little bit. The syllabus for the tutorial in the summer tutorial in Los Angeles is in there under that link. Please read it and shoot me an email if you'd like your own copy or you had some other question. Okay, thanks for your attendance today, folks, and enjoy the weekend. It's Friday in the lands down under, and it's past 11 o'clock, so it might be time for quiet Bloody Mary by the pool as we wait for the US trading session to start in a number of hours' time. Thanks for your attendance today. Bye-bye.